All right, welcome back to the channel. So today we'll be looking at the debt to equity ratio for Cadbury Nigeria PLC. So Cadbury Nigeria PLC is a food and beverage company, and you might not be so familiar with the name, but when I start mentioning their products, I bet you say you've known them for a couple of years. So Cadbury Nigeria PLC are actually the producers of the famous Bovita chocolate, the Bovita beverage, and also Tom Tom, the almighty Tom Tom, that has been for years. I think I've known that since I was a kid. Also, they are the producers of Buttermints, Clorette chewing gum, and the Cadbury 3-in-1 hot chocolate. So those are some of the products. Let me give you a glance into that. So, and recently they launched a new product. They launched a new product, the Bovita biscuits. Yeah, so these are some of their products here. This is the hot chocolate drink. These are the Tom Tom, the Buttermints, the Bovita, the Cadbury chocolate drink, and this is the new biscuits they just launched. This is the Bovita biscuits they launched in 2023, and I think this brought them a revenue of 640 million naira last year. So I've actually tasted it, and it tastes really good. So whenever you're in the store, you can just check that out. Now, this is not a promotion video. I'm just trying to attest to the fact that it actually tasted good. So let's move in real quick. So you might be curious to know what debt to equity is, and yeah, I'm here to tell you that. So the debt to equity ratio is a simple financial concept that shows how much a company relies on debts versus its own money. So it's actually, say for example, you borrowed money to buy a house, and you actually still put some of your money inside buying that house. So the money that comes from your pocket that you used to buy the house is your equity, and the money you borrowed is the debt. So the debt to equity ratio is like a scale that compares between the two amounts. Which one is more? Is it the debt or is it the equity when it comes to financing the operations of the company? So, and a higher ratio here, which indicates more debt. So whenever it is higher, I mean greater than 1 in this sense, it can be risky. So for the company, it's just like carrying a heavy load. It's a big burden on the company. And a lower ratio means more equity, means that the business owner actually puts in their personal money, more of their personal money, into the running of the business, and that is actually safer. It is actually safer. It's just like having a very solid foundation. So companies actually use this ratio to show how much they rely on debts versus their own resource, and this ratio also helps investors like you and me and creditors also to understand the company's financial stability and competency. Yes. So although we have some companies that do not have that, their debt to equity ratio is 0. The debt to equity ratio of some companies can be 0. It means that they do not rely on debt. They are not funding the company with any debt. So all they are investing into the company is actually their money. Now let's go back. I think that has given enough light into what debt to equity ratio is. So we are checking the debt to equity ratio for Cadbury Nigeria PLC. So before we kick off, as the normal custom, let's check the data sets for this that produced this beautiful looking pie chart. So the total debt for Cadbury Nigeria PLC in 2022 was 23 billion. So they actually borrowed 23 billion, and the total equity, which is their own money that they put into the business, was 13.3 billion. Now the whole money for that year was 37 billion. Now out of this 37 billion that was put into the company in 2022, 64% of that money was from debt and 22% of that money was from equity, which is the owner's money. Now, and that resulted in the, let me put a zoom here so you can see clearly. So here we have total debts to be 23.8 billion, total equity 13.3 billion, which is 24% of the total money invested for that year, and 23.8 billion, which is the total debt, is 64% of the overall money they invested in the company in that year. So, and that resulted us to get the total equity, you divide the total debt. To get the debt to equity ratio, you divide the total debt by the total equity, and that led us to a ratio of 1.79, which is greater than 1. And I think I've explained what that means, but we'll still reiterate on that. So going back to our chart, we'll see that now the red part here. The red part here is showing the part of the company that is being run by debt. This, and we see 22% of it is equity, and their reliance on debt is 64%, and their reliance on their personal money is 22%. So we will see that this company is relying more on debt, and it shows a very high risk to creditors and investors. So this debt to equity ratio is something you might need to look at. It's a vital metric to look at when you want to make investments in a company, or when you want to confirm the financial stability of a particular company. Now, this 1.79 debt to equity ratio is actually saying that the Cadbury Nigeria PLC relies more on debts than they do on their personal equity, their own personal money. So let me walk you through their financial statements. So sorry about that. So for their total equity, in my own opinion, and as the balance sheet is showing here, Cadbury is not doing so well when it comes to their financial stability, because we see here that in 2022 they did 13.3 billion naira in total equity, but then in 2023 they are doing 6.5 billion naira, and that is negative. So they have gone down. They've actually gone down, and we can see that there's a negative change here, which is 149%. So they've actually gone down, and this is not saying this is not speaking well about the financial stability of this company. Now let's look at their debts. So what we just checked now is the total equity. Let's look at the total debts and see how exactly that looks. So also here we can see here that in 2022 they had a total debt of 23.8 billion naira, but in 2023 it increased to 43.2 billion naira. So we can see that this company is loud on debt, so loud on debt. This is a difference of about 20 billion naira. They are so loud on debt, and that is in my opinion, that's a red flag. And according to this financial statement, that's a red flag to investors. And when I was making the research for this company, I was really feeling sorry for them, because that doesn't tell so well. If I was to invest and I check this out, man, I'll have to just find an alternative. But on the other hand, it might also be a good place to invest, because now it's a higher risk when you invest in a company that is high on debts like this. Yes, the returns will be more, because they are actually leveraging on this. When a company is leveraging on debt like this, they can actually acquire more assets and expand over time, and that is actually bringing more dividends to its investors and creditors. But then this is actually a threat to the solvency of the organization here. Now this 1.79 ratio is saying that the company, like I mentioned before, the company is relying more on the debts than they are relying on their equity. So that's on that. Now finally, let me take you to a material, a journal, to finalize on this debt to equity ratio. Let's take a zoom, so and let me put this in perspective. So this place actually gives us a clear explanation of this debt to equity ratio. So it says a debt to equity ratio of 1 means that the creditors and the stakeholders equally contribute to the asset of the business. So it's just like 50-50 when the ratio is equal to 1. Now when it is less than 1, it means that the portion of asset provided by the owners of the business is greater than the proportion provided by creditors. And if it is greater than 1, the ratio indicates that the portion provided by creditors is greater than the portion provided by the owners of the business. And creditors usually like to see a low debt to equity ratio, because the low ratio is an indication that they are is an indication of greater protection to their money. So nobody wants to invest or give credit to somewhere or someone that you are not sure they will pay you back. So nobody wants to waste their money and their resource. So that's just how. So the creditors like to see a very low debt to equity ratio, because it shows a sign of safety for their money. Now the stockholder, on the other hand, which is the other owner of the business, they like to get benefit from the funds provided by creditors. Therefore they like a high debt to equity ratio. So it actually favors them, because it helps them to do more things for the company when the debt to equity ratio is high. So that is all about this. And I think I didn't mention, I didn't explain the bar, but I trust that you understood that the red part of the pie chart is representing the total debt, which is 64%, and the green part of the chart is representing total equity. So that is that about this video. I thank you so much for staying with me up to the end of the video. Thank you for watching, and I really do hope to see you in my next video. Please kindly like and comment on, and if you have any comments, you can just drop it in the comment section. Also, do not forget to subscribe to the channel, and then till we see again. Bye bye.